This short tutorial explains the impact on the financial statements of events relating to inventory management. In Scenario 1, we consider a simple example such as a shop. A shop buys and sells goods that have been made by others. A shop purchases products from suppliers. The products are held in the shop's inventory. The shop's inventory is presented on its balance sheet. Inventory is measured on the balance sheet at the lower of cost or net selling price. When the inventory is sold to a customer, the value of the inventory sold is recognized as a cost of goods sold expense in the profit and loss statement. In the income statement, the cost of goods sold is deducted from the revenue earned to give the gross margin. Operating costs are then deducted from gross margin to give operating income. Scenario 1 related to a typical shop. In Scenario 2, we consider a manufacturing company. A manufacturing company converts raw materials into finished goods. Semi-finished products are referred to as work in process. A manufacturing company incurs direct costs when converting raw materials into finished goods. Direct costs include the cost of direct labor. Direct costs also include the cost of overheads such as equipment, energy, and management supervision. The inventory valuation on the balance sheet of a manufacturing company includes the total cost of raw materials plus work in process plus finished goods. When the inventory is sold to a customer, the value of the inventory sold is recognized as a cost of goods sold expense in the income statement. In the income statement, the cost of goods sold is deducted from the revenue earned to give the gross margin. Operating costs are then deducted from gross margin to give operating income. Continuing the manufacturing example, we now consider how work in process is valued. Raw materials inventory can be released to work in progress in a number of ways. The main options are FIFO, that's first in, first out, LIFO, that's last in, first out, and average cost. For example, let's assume that the raw materials inventory held by a company was purchased in the following order. Firstly, 5 units of raw materials were purchased at $5 each. Next, 5 units of raw materials were purchased at $6 each. Finally, 5 units of raw materials were purchased at $8 each. With FIFO, the company assumes that the items that were first purchased into raw materials inventory are first released to work in process. Thus, closing inventory is valued at most recent prices. If we assume that inventory is released to work in progress on a FIFO basis, the cost of goods sold is $15 and our closing inventory value is $80. With LIFO, the company assumes that the items that were last purchased into raw materials inventory are first released to work in process. Thus, closing inventory is valued at oldest prices. If we assume that inventory is released to work in progress on a LIFO basis, our cost of goods sold is $24 and our closing inventory value is $71. If we assume that inventory is released to work in progress on a weighted average basis, in our example, the average unit price is derived from the total cost of the inventory divided by the total units. Total cost is $95, total units is $15. Therefore, weighted average cost is 95 divided by 15, which is $6.33. So the cost of goods sold is 3 units times 633 equals $19. And our closing inventory value is 12 units times 633 equals $76. Using the specific method of raw material inventory valuation, each specific unit removed from raw materials inventory to work in process is valued at its specific cost. Hence, if we pick, as per the diagram, COGS equals $19, our closing inventory value is $76. Hence, depending on the company's chosen stock valuation policy, the company can get differing cost of sale and closing inventory values.